I think that's true, but keep in mind, Steve, you go back to April in this country, people said the unemployment rate is going to continue to rise. We're going to get to 19% on U.S. unemployment by June. It did not happen. Instead, we started adding jobs back quickly. The unemployment rate is coming down. Now, you're right. It's alarmingly high. We're at 12% on the U.S. unemployment rate, and we need more industries to pick up and to hire people back. So that will take more time. I think the unemployment rate is something that will keep you until maybe 2 years from now, where we get back to closer to pre-crisis levels. So that is true. But here, keep this in mind. For investors, that just means the Fed is going to be easy for a long time to come. I think we saw that last week in the Federal Reserve minutes. So they're going to be at zero. They may even do some outcome-based forward guidance. And that really just means easy monetary policy for a long time. And, that means when I looked just before this segment, 10-year Treasury yields at 67 basis points, something like that. There's no yield there. There's very little inflation. I think investors still stocks, risk assets generally, credit sectors in the U.S. bond market, for example, are still attractive places given the economic backdrop. Jobs will come, I think, as we continue to recover.
I don't know about you, but I'm pouring through the John Bolton book at the moment. I can't see it behind you, the room where it happened. And one thing that's very clear is the president, which we knew anyway, the president likes to use political events outside, or indeed contention outside of the US, in order to improve his popularity in the US as well. Do you have concerns about trade wars, maybe Trans-Pacific, maybe with other parts of the world, which actually could dent this economic recovery ahead of the presidential elections in November?
Yeah, it's fairly unpopular, as you know, so there could be some surprises here. A lot could happen. I mean, I'm old enough to remember Michael Dukakis leading in 1988 over George Herbert Walker Bush, and then we know how that ended. Similar story the summer of 2000 with Al Gore, and we know how that story ended. So I think the big message for me and for clients and investors, we can't make big judgments right now based on what's going to happen in portfolios, based on the outcome of the election. So we're looking out, we're taking a longer term perspective. And I think what I would say is that the prediction markets are right, Steve. The prediction markets, the last I checked, are pointing towards a Democratic sweep. And if that happens, we do probably have higher taxes in this country. But the book I'm reading right now is called The Deficit Myth. And it's the idea that Stephanie Kelton's book, and it's the idea that, deficits don't matter, that we can grow them. And that so I think if we do have a Democratic administration, we get higher taxes, we get more deficit spending down the road. Some investors worry, is that bad for stocks? I'll trade some of that, I think, for less of what you were bringing up, the tariff, the constant Twitter tariff trade wars type stuff that we have to deal with. That'll go away under the Democratic administration.